Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo. On today's episode, you're getting just me as Alex is not available. But today's episode, we're going to be talking about sequence of returns risk. And what sequence of returns risk is, as you are entering retirement, those first 5 years of retirement in terms of the market being up or down has a huge effect on whether or not you outlive your money, depending on your plan or strategy. A lot of people, when they get to retirement, they think they're going to take this fixed income stream from their portfolio, not understanding that if the market's down and you take money from your portfolio as well, if that portfolio is in the market, it's not only down because of the market, you're also taking distributions from that portfolio. That affects whether or not you outlive your money. Because when it goes down further, to bring that money back up, to bring your portfolio back to where it was, you have to have a much bigger rate of return. And so today I'm going to do a quick calculation and showing you what sequence of returns risk is. So if you haven't checked us out on YouTube, definitely go over to the YouTube channel, as that will have the video for today's episode and gives you the visual side of it. So without further ado, let's jump into the visual side of today's screen. So again, here's a sequence, how many people look at retirement, right? And we'll look at just 10-year rolling periods of time here. If we had a $5 million asset when we get to retirement, and in that $5 million, we're taking $200,000 of income, and we want to keep pace with inflation with 3%, if we get an average rate of return of 7%, and this is how most people look at their portfolio distribution, meaning turning on the income stream, well, what this looks like is this really clear and looks like it's going to work out very, very well, right? You start at $5 million and you can see it actually goes up over time, because how this is showing is it's 7% every single year. So if you get 7% every single year without a down year, this works really, really well. And this is actually what Alex and I see a lot of financial plans out there based off of. They're saying, well, the average rate of return is 7%. So if you get that, this is what this looks like. What it doesn't take into consideration is, I don't know about you, I don't get the same rate of return in my portfolio every single year now, let alone I'm not going to expect that in retirement. So what can happen in retirement? Well, let's just do a random rate of return. You can see it starts at -3, -9, and you've got some 21% years, but still the 10-year average is a 7% rate of return. So same 7% average rate of return, but now taking a more realistic approach around, it may not be 7% every year. Some years might be positive 19, some years might be negative. Well, what does that do to this portfolio? And so now you can see what it was, the 7% fixed, which is the bar graph here, was trending upwards. Now you can see the lines. Now it's a much different story, where they were projecting to be at 10.3. Now you're at 5.7. Now, this is still good considering it started at $5 million. This may be really, really good. But what if the projections, or what if the rates of return didn't go as easy as this looks? Meaning, it was -3 the first year, but it popped positive 15 the next year. What if we had a couple years of negative down years? How would that affect whether or not this person outlives their portfolio? So now you can see, now I went a little bit overkill here, but I'm trying to explain how sequence of returns risk is a bigger deal if you have not planned appropriately for it. And you can see it's -9, -7, -5. It's still a positive 7%. But the positive rates tend to come towards the end of the 10-year period. And so when you look at this time frame, now you can see, well, now they've outlived their money in year 25. Right? Because again, the first 3 to 5 years of retirement, whether or not your rate of return is positive or negative, has a huge effect on your portfolio if your plan is just to kind of take an interest-only approach to your retirement plan. So Alex and I speak into this in terms of when we're building a financial plan, we want to make sure we've got different buckets of money, some money in the market, some money not correlated with the market, so that we can weather this storm, because we can't predict what the market's going to do. We can make sure your portfolio is allocated appropriately and have different asset classes so that you're not concentrated in one particular asset class. But when the market has a recession, oftentimes it hits the entire portfolio. We need to make sure we're planning for that aspect. And the last thing we want to do is plan for 7% average rate of return and not take into consideration what the real rates return could be, even though it averaged out to a 7%. So rule of thumb here, and what we always try to make sure we're getting across is, when we get to retirement, make sure we've got different assets in different buckets and not all of our assets in one portfolio being stocks and bonds, because bonds also go down. All you have to do is go look at 2022, where stocks are down and bonds are down. While those two asset classes, stocks and bonds, are oftentimes correlated with one another. So you have to have different buckets so you can weather this storm if it occurs, and we don't know if or when it will occur. That's today's episode. We hope this episode was valuable for you. Make sure you check us out on beerandmoney.net. At the top of the page there, if you have any questions on today's episode, the contact us is a great spot to reach out to us. Or maybe you've been listening to us for a couple of years now, and you're like, hey, I'd love to know what my financial scorecard would look like. There will be a link in the show notes where you can go get your own financial scorecard. Again, Alex and I don't see this. It's just for you, so you can kind of get a lay of the land of how you look based right now. And then if you wanted to reach out to us with your personal situation, there's a link there as well. Again, hope this episode was valuable for you. Have a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
8192847.1, expiration date July 2027.